Welcome, everyone. This is Carlos Murguia from the Arrowhead Center. Thank you for joining us today for the Cruces Angels training on due diligence. And before we start with the session today, I would like to recognize the partners who are making this effort possible. We would like to thank the following organizations: the Hunt Center for Entrepreneurship at NMSU's Arrowhead Center, STT Ventures, the Stanford Angels and Entrepreneurs Texas Chapter, Joseph Advisory, Audace Capital, the El Paso del Norte Foundation, and Dr. Beto Pallares, who is the Cruces Angels Chairman and Adventure Capitalist. And I'm going to start with the introductions. Today, we have Beto Pallares, who is originally from Ciudad Juarez and raised in El Paso. He has a diverse career, spanning from being in telecom as an executive, a restaurateur, venture capitalist, and he was also a professor at New Mexico State University. Beto has expertise in seed and early stage venture investments. He advises a family office on investments, manages 2 funds, and is very passionate about supporting entrepreneurial growth in the Botoplex region. That encompasses Chihuahua, Ciudad Juarez, El Paso, and Las Cruces. He also holds different board positions in private and one public company. And we also have Dr. Jack Loveridge, who is coming from the Stanford Angels and Entrepreneurs Alumni Chapter in Texas. He's also from El Paso. He's a historian, social entrepreneur, and a tech policy advisor. He co-founded the Initiate Digital Rights in Society and serves as a senior policy advisor to the Paris Peace Forum on Artificial Intelligence Regulation. He has several roles, including Hog University, Stanford Angels and Entrepreneurs of Texas, and Jack holds a PhD from the University of Texas at Austin, and he has been associated with global universities like Oxford, Yale, Harvard, and the Cooper Union. So welcome, Jack and Beto, and the floor is yours.
Thank you very much, Carlos. I'm very pleased to be here today. I see some familiar faces. John Chavez, welcome. John is a seasoned angel investor who was the executive director of the New Mexico Angels. We're very active in the New Mexico landscape. And Jeff has been an attorney supporting angel and venture deals throughout the Southwest for years now. And Josh Ladd, who is also a board member of the Cruces Angels. Thanks for being here. I guess I'll begin by just recapping what we did, a few weeks ago. What is the intent of Cruces? And what's the intent of this particular Zoom session? So Cruces was created to continue to foster a mentality around supporting particularly high-tech, but also just regional deal flow in the Southwest, primarily El Paso, Las Cruces, so that entrepreneurs have a potential source of capital they can tap. Angels are an important part of every ecosystem. They're usually past friends and family. They're the next set of capital that people need to access. But more than capital, you access expertise and time and experience and sounding boards and relationships. So angels play a crucial role in the development of any ecosystem. So we thought that it was long overdue to reinvigorate such a group in our region. With this in mind, it is not the same to just sort of give someone a fish. Here's a deal, invest in that deal, but we must teach how to fish so that you understand the process of looking at deals time and time again, develop your own pattern recognition, and over time, make more judicious, prudent investments in deals in our region and beyond. So that's the intent of these particular educational endeavors. And New Mexico State, through Arrowhead Center, is our educational partner that helps us host these particular sessions so that we can dialogue and give you more feedback without having to pick up a book. Not that that's a bad idea, but what we're trying to do here is give you multiple perspectives around the same topic, which is angel investing. So with that in mind, I'll let Jack take it away.
Thanks so much, Beto. I really appreciate this opportunity, and Stanford Angels of Texas is excited to be working on building out some Cruces Angels because it is going to be transformative for our region. I think I'll begin by just addressing a very straightforward question, which is, what exactly is angel investing and how is it different from traditional forms of investment? It's a very simple distinction, but it is a crucial one in that we are looking to invest in early stage companies at the level of ideation or just about to get off the ground with a product into the market. There's a higher rate of risk by definition, but also there's a higher rate of return. And as Beto mentioned, there is a greater amount of involvement on the part of the investors themselves. So this is something where you see mentorship and the personal experience of the investor coming to play. This is an optional thing, but it really does help the early stage ventures to get off the ground and gain traction. And generally, angel investors would want to have only about 10% of their total investments in angel level enterprises. So vetting will really be something that the angel has to take on to their own shoulders, unless they're in a group, in which case there is a little bit more of a distribution within a network of that process. But that research component, doing the due diligence, is exactly why we're having this discussion, and the tips that are going to be coming out of it hopefully are going to be invaluable to you all as you begin this journey of angel investment. So Beto, I'll throw it back to you and ask you a question. How would a new investor determine the potential for growth of an early stage startup?
That's a good first question. And let me start by saying that in broad level, right? When you're an angel investor, you can invest for a number of reasons. You could like someone and say, I just like something about that entrepreneur and I want to support them. Or you could say, well, this is good for my community and therefore I should invest in this. But the reality is that you want to invest to maximize your own financial returns, right? You want to do that because through the creation of financial returns, you have more capital to do all the other things, charitable or not, that correspond to that. That's part of the mission of being part of an angel group. Now, the first question you asked, Jack, is, how do you determine what's a good deal? And one of those processes is time. Time is on your side, and you use that time wisely to understand as much as you can about that particular opportunity. Now, if you happen to have a PhD in biology and someone brings a deal to an angel group or to you that is right down your specific expertise, maybe you wrote a dissertation about this, maybe you published lots of papers, maybe you work for a big biotech company, or maybe you were a supplier to a biotech company. So chances are you know quite a bit about that particular industry, maybe even about the inner workings of that particular type of business. So that could, in theory, be a great investment for you because you have a lot to add, you have a lot of knowledge, and you can unlock it to the benefit of this particular investment and help them avoid a lot of mistakes. Now, what happens if you're not an expert in an industry? How do you go about vetting a deal? Well, first thing you do is you try to find other angels or individuals that have some expertise on that, right? And then you start to ask the very basic questions. Tell me how you came up with this idea. How many years have you worked in this industry? Is the idea patented? So you can go through a list of different questions to help you ascertain how valid is the responses to the particular queries, and do they fit in a framework of investable, not investable, right? Now, I usually try to come up with 5 different buckets, if you will, of things that matter to me. The first one is this person talking about going after a big market, right? How do you define a big market? Well, some people define a big market as it's $1 billion or more. Or a big market is this company can somehow grow in the next 5 to 8 years to $100 million in revenue. And so to be a company operating and generating $100 million in revenue, by definition, the market you're going after needs to be orders of magnitude bigger than $100 million. So if you reach 10% of the market, then the market is $1 billion because you're generating $100 million. So the market and the potential large size market is very important. Now, if your deal is, I want to be the best artisanal tacos in El Paso at $60 a taco, you might have a really good opening night and then nothing else after that, right? Because in our mind, we start to benchmark what a taco should contain and be and cost and whatnot, right? Same thing happens with technology companies. The more you see them, the more you start to create patterns around what you're looking at. The market is very important. Second thing is the team. The team is indispensable. Does this team embody or have the kind of experience that we need to scale a company in this particular market? Or does this individual, are they charismatic, connected enough, knowledgeable, experienced, persuasive enough to bring others on board and create a team? That's especially true when it's a solo founder or someone with a good idea, maybe some experience going after a big market, but they haven't built the team up. So the team is very important. The third thing is the technology or how protectable that technology is. You have an issued patent, so the patent pending. You have some secret sauce to what you're doing that makes it very unique and somehow gives you a natural hedge or a barrier to entry. Okay? The fourth thing I look at is, do you have a prototype? Or are you just talking into thin air? You know, how difficult is it to build a prototype? If you're going to pitch an app and you don't have a prototype, you might have a problem because prototypes for apps are very low cost to build now, right? But if you're dealing with something that's hardware focused or robotics or things like that, those require more money, right? Then we're going to rely on big market, experienced team, protectable technology, and maybe pay a little less attention into prototype, or maybe the funding that comes in post-build a prototype. The last thing I look for is revenue. Has someone paid you for this? Have you created an opportunity where someone says, I want to transact and I want to be your first customer, or I want to place an order that as soon as you have what you're building, I want to make sure I honor that order and buy that stuff. So I hope that helps create a picture around the questions and the type of buckets that you want to put these questions into.
I think that's a really useful breakdown, and it's so easy to count those. That 5-finger rule is something that you can always fall back on. I would like to kind of turn now to the specific industries, just give a little bit of an overview of what industries and sectors are currently more favorable for angel investment. And this, I think, builds off of what Beto's laid out here in terms of evaluating angel investment potential enterprises. So you're looking for a large market, as Beto mentioned, and high growth potential. Another key word here would be scalability. Is this something that can translate into larger returns over time? Is it easy for that process or product to be magnified to a much higher level? Potential for disruption as well. This is why tech startups are often favored by angel investment syndicates and angel investment networks. Patentable IP and products and processes that can be protected. So that just signifies returns over time, and that you will actually see a great return on your particular investment. So tech and software, health and biotech, fintech, e-commerce and commerce goods, renewable energy increasingly, and agri-tech as well are pretty hot right now. And that's not to say that that excludes other sectors. It's just to say that these are some of the key areas where returns are potentially the greatest. So I think that's a fairly comprehensive overview, but feel free to add anything to that list, Beto. And we can turn now to another question. And let's see. So what strategies for you have been most effective, in addition to what you've just laid out, for maximizing returns in the world of angel investment, Beto?
Well, one strategy that every angel should invest, should employ, is really network heavily with experts in a particular industry. Really understand, to use a business school paradigm, think about Porter's five forces, right? The industry, the competitors, the suppliers, your internal resources of the company. Where do all those things stand so that you understand holistically what's going on in a particular industry, right? One of the things you need to do is do thorough due diligence to better position yourself to have educated conversations with other angels or with founders or potential partners to those founders about that particular deal. And I would also suggest that another strategy is to understand what an angel deal structure should look like. In other words, some founders might very well be coming up with something that's novel, coming up with something that's very representative of years of hard work, and they might set a price for an investment that's very high. And so you as an angel, and certainly founders as well, need to familiarize themselves with what are the terms acceptable for an angel deal. I'll give you an example. And I'll use the car market as an example. If I show you a Ferrari, right, you might have an idea that that's worth a lot. And you might have an idea that that might not be the car for you for a number of reasons. So if an entrepreneur brings you a Ferrari and is pricing it as such, then you have to make the determination if you're in the market for a Ferrari, right? In terms of the price and the maintenance. Or an entrepreneur can bring you, say, a Ford F-150. Straight off the line, you say, okay, I understand trucks. I understand F-150. I understand sort of what the price range is for that. And I'm going to buy 10% of this truck. So I'm going to put in $9,000, right? A fully loaded F-150 is going to be about 90 grand. So I'm going to buy 10% of this truck. So euphemistically, you're going to buy a percentage of a particular startup. You got to understand what the whole price is of it right now and what percentage you want to invest. And there's very, very, very different ways to do it. But my point for this example is that you as the investor need to understand what are the terms of investment, right? And how do those things get consummated? Now let's talk about how deals get consummated. It has to be more than a handshake, okay? When you're investing your own money as an angel investor in a tech deal, you are either buying equity or the future promise of equity, or you're issuing debt to the company in some fashion, such that you have rights over some aspect of that unique technology, okay? And those rights are codified in a legal document. It could be a very simple document, like a simple agreement for future equity, SAFE, a SAFE, or it could be a convertible note that converts to equity in some future date, or it could be a price round where you're actually buying shares of a company, or it could be an LLC where you're buying units of it. Whatever the flavor of deal it is, know that it requires a legal structure to understand what your ownership or potential ownership should or ought to be, okay? Now, if that sounds like you should get a lawyer involved, yes, I highly recommend it. Unless you're an extremely seasoned angel investor and you've seen dozens and dozens upon dozens of legal documents and you're reading plain vanilla documents and you say, yeah, I understand this, I feel comfortable with it, I'm going to sign it. I highly advise you, okay, to go to a legal expert and say, this is my understanding of this. Is it accurate? Or I don't quite understand this. Help me understand this and put it in context. I'm interested in this particular deal. Now, Does that mean that your cost to do a deal just went up because you got to get some legal help? Potentially. But we're not talking about, putting in $1,000 or $2,000. We're talking about you potentially investing 5,000, 10,000, 20,000, 100,000, or collectively as a group of angels investing some large amount of money. It is worth to do the work up front to understand legally what you're getting into. Throughout the history of my career in investing or as a sideline person understanding how investments are made, there are three major mistakes that angels make and still sort of make them repeatedly, but it certainly was the case years ago. Number one, you don't do enough diligence. That means that you don't ask enough questions. You must ask questions. You must document what the responses are. You must validate and check that those responses make sense, right? And you do that by building out a network or working through an angel group, okay? But you must ask questions. You got to do due diligence. Number two, you must get legal advice when necessary, where appropriate, because at the end of the day, friendship is governed by trust, but business is governed by contracts. And so you're entering into a contract with an entrepreneur or with other investors to give up some money in exchange for something. You got to understand what that transaction looks like. And number three is you got to think long-term on the investment. The moment you write your check and make an investment, that is just the beginning. You have so much more to do as far as reporting, understanding, reserving capital. So I hope that helps encapsulate some of these particular nuances that are necessary. Other questions?
Moving right along, it would be good here to talk a little bit about the difference between the diligence process, the due diligence process as a solo investor, like when you're flying solo as an angel, versus when you're in a network. To what extent does that mitigate some of the risks? This is just a question I think that comes out of your previous response there, Beto.
Yeah, so if you're very experienced, you've done this a lot, you might be able to quickly determine whether you want to invest in a deal by yourself. And that's great. Some folks have that capacity, they have that time. But the thing to think about is really to figure out what kinds of resources you can share in a network so that you're able to, in a very strategic way, rely on each other, right? So let's say, for example, you're looking at a deal that you're very interested in. Maybe it's in the transportation space. And there's someone in your network of angel investors that operated or knew about a transportation company, right? And that person could help with diligence. And then maybe there's a person that has a legal background. That person can help look at, if that company is saying, oh, we have contracts with XYZ carriers that we can offload. Well, part of the diligence might be to look at the contract. The third thing might be if there's an accountant in the group or someone who's been a CFO at a company that can help look and validate through the financial statements. So in sum, if you're adept and highly trained at doing all those things on your own, awesome. If you're not, and I can tell you I have years of experience and I can always use some help, you want to rely on the network of angel investors that you have so that you all collectively get excited and look at the opportunity.
I think that's helpful. And I think that does tell us a great deal about why there are some significant advantages in moving forward as a group, as a herd. Let's think now. I think a good question here would be looking for some real world cases where diligence played a crucial role in the success or failure of an investment deal. From your experience, Beto, what are, not naming names, but giving us a broad strokes picture, what are some of these instances that you've seen where it was the due diligence process that really made that deal either successful or enabled an investor to walk away from something that might have gone south?
Yeah. I'll start with one actual live example where we did not go into deep due diligence, okay? But there was a definite red flag that had me pull away from going further, okay? So some years ago, someone brought to me a very interesting deal. And they talked to me about this deal, and it was a hardware, software kind of permutation. And this was a deal that only people in the know would get to invest in. And you had the opportunity to invest early. The valuation, I think, was 4 billion at the time. Okay. And they were raising, I think, about 400 million. And the deal looked really interesting. And I said, okay, this is interesting. I'd like to do due diligence. And what I was told was, yeah, you can't. You know, they're very secretive about their data. And all you have to do is look at who's on the board. That deal was Theranos. Okay. So if you know Theranos, the founders ended up going to jail for fraud, right? So that was one situation where the data didn't make sense or the message didn't make sense, right? It is a highly technical type of company. I happen to have been on a board of something that did something similar. So I knew a little bit or knew somewhat what to ask. So when push came to shove and the person said, no, you can't ask that. You just got to trust it. There's no such thing here. I just said that, you know, branches are governed by trust, but, you know, business is governed by contracts. And as a fiduciary, by the way, I'm a registered investment advisor. Okay. So I'm governed by the SEC with respect to, you know, the advice I can give and so on and so forth. So I have to be very seriously. Okay. So, you have to look at the data and really trust your gut in terms of red flags. Now, if I had nobody to bounce that off with, then I might have made the wrong decision and said, well, this sounds really cool. Maybe this is a deal that you gotta be in the know and you gotta invest in it, right? It would have been a real fiasco. It would have been money thrown away. By the way, diligence does not guarantee that a deal will not go south. It happens. But you want to avoid as much as possible the deal going south because you avoided asking something that you thought was important, or you second guess yourself, or you didn't bounce things up with others, right? So it's really important to take that seriously. There's nothing wrong with having a prepared list of questions, okay? Because when you make an investment, you fill out some paperwork, right? And most angel deals.
Maximo, stop staring at me.
Most angel deals, you know, are looking to bring on board accredited investors. Okay? So you have to say that you're accredited and that you understand the risks of investing in it. So the burden of looking over the investment docs and satisfying that you're making an investment to the best of your knowledge, it's up to you. The company's presenting stuff, right? If they present stuff that doesn't quite jive, but you still invest in it and you lose your money, you basically said you understood that, right? Does that help answer the question?
Definitely, and absolutely a great story. I'll remember that one for a long time. Former Stanford classmate of mine, Elizabeth Holmes. We don't like to think about that so much, but
Yeah, please slow down.
yeah, it's very important to remember that case and to internalize its lessons. And again, that's why we travel as a pack. It just helps that process. If something seems off, trust your gut and just bounce these ideas off of everybody that you possibly can in our network, and that'll really smoothen up the process. I think it would be a good time now to jump into the sort of nitty-gritty of the process in these questions. So when you're evaluating the financials of a startup, what are some of the key indicators or red flags to look for? Is it the precise quantitative information that you're looking at? How do you unpack that? And what are some of the tools for making that process a little bit easier on your end, Beto?
Yeah. Run that by me again. I was reading the sidebar here in the meeting chat.
Yeah, no worries. Just thinking about the specific financial indicators that you'd be looking at. So what are the red flags that you're scanning for? And what are some of the tools that help you unpack all the quantitative information that you're digging into?
Yeah. So first of all, a lot of early stage companies might not have a level of sophistication to give you very detailed financials. But they should, at the very least, understand the cost structure and the potential revenue structure of how they're going to derive revenue from a particular thing. It could be that a company says, I'm going to do this, invest in this, and we're going to license this out, right? So we're not going to build a product. We're going to file the patents, prove that it works, and license it to a larger player. That person should understand the mechanics of licensing and how much potential revenue that could represent, right? Or if you're going to build a product from beginning to end and get it into market, you should understand the ramifications of doing that. How much money will it take? What will it cost to produce one unit? So the unit economics become very important, okay? So at the very least, the entrepreneur should have some level of command over the unit economics of delivering XYZ product or service, and then repeating that over time, okay? Now, in an ideal world, you'll get a balance sheet, an income statement, and a cash flow. And those three documents work well together, okay? And the way I like to explain those three financial documents is as follows. The balance sheet is usually a snapshot, okay? A point in time, but it doesn't tell you the full story. It's sort of like the movie poster where you see what the movie's going to be about. You see the protagonist, you see kind of a little bit of the stuff, who produced it. But it doesn't tell you the whole story, okay? Now, the income statement tells you a little bit more, right? Kind of tells you there's money coming in and going out and, you know, other data points that come. To me, that's like the trailer, right? You see sort of the best parts of the movie. But the income statement is like the full reel. You know whether that business works or not. So your usual early stage companies may not have that in full, or may not even have it fully accurate, meaning that they have a pro forma. They have a projection of what this must look like, okay? So then your job as an investor is to understand, is this typical for this particular kind of company in this particular industry? You know, if someone says, excuse me, I am going to introduce a new kind of, you know, biofuel, and I need $5 million for the plant, and then by the end of year 2, I'm going to be selling 1 million gallons of biofuel out of my little plant at a cost of $1 a gallon. It'll be amazing, and so on and so forth. Does that actually make sense? How long does it take to build a plant? How much do these plants actually, you know, take and consume? What is their volume? What is their downtime? What is their upkeep? How quickly can this biofuel get certified to be used in commercial vehicles? So there's certain things that have to make sense encapsulated in the finances of that particular fund, okay? So for me, I'd like to see an attempt, if not some level of accuracy, on the balance sheet, the income statement, and the cash forecast. Again, those three documents work together. They tell you a lot about the potential health of that company. These projections might go out 3 years, maybe 5. You can start to compare to other companies that are similar, or maybe even incumbents in an industry, and say, do these numbers make sense? And then one of the things you want to pay attention to is the growth rate. Does the growth rate merit investment, or is the growth rate so anemic that it's really not a deal that makes it very interesting for them? Or is the growth rate so stratospheric that it doesn't make sense? Of course, every high-tech deal wants to create this kind of hockey stick that you go from a little to a lot very quickly. And you want to see some of that, but you want it to be somewhat realistic, okay? sometimes we see deals that people say, well, I only need X number of $1 million and I don't need any more money. Chances are it's going to need more money and more time, and you'll miss milestones. I think I've only seen one company that has met milestones or exceeded them based on the early projections they have. So I'll add to this that the entrepreneur needs to have a certain level-headedness and humility about him or her to understand that sometimes things can change and be able to take that feedback from the angel investors.
Thanks very much. And out of curiosity, when you're approached by a team of entrepreneurs or by a single entrepreneur, in the past, have you ever, really fallen in love with an idea, or you really like the team, but they're just not there yet? Do you say, let's continue the conversation, or are you moving so quickly that you just, keep going forward? Do you give them feedback and advice, and say, if you return this information to me, show me some more data? Is that something that you like to do, or is it just so, fast paced that you don't have time to stop and give that kind of feedback?
I think it's important to give feedback, right?
Yeah.
The feedback can be as simple as, look, this sounds really exciting. I don't know if it's for me yet, but it sounds exciting. I want to learn more. And my usual pace is, give me 2 weeks to digest this. I'm going to ask you more questions, maybe 2 weeks after that. Some sort of process where you reach that comfort, right? The idea of saying first pitch, let me wire money, hardly ever the right move. You really want to understand what's going on with that particular business, right? God forbid there's other needs that entrepreneurs have, which happens. But I've heard horror stories where an entrepreneur is upside down on some other investments or personal finances, and they see it as okay to take investment money and apply it for something else, right? So again, time is on your side, right, as the investor. If you operate within a group structure where you're all sharing information, you're being transparent, angel to angel, then you can diligence a deal back and say, oh, he or she told me this, but they told you this, that's different. We got to talk to him or her and arrive at what's the right response. Or, is there some misinformation that we need to clear up? So there's a lot to think about, but I think it's very much in your purview as an angel investor to say, I like it, let me learn more, let me spend more time, or let me talk to, a few other angels, let me see what other people are thinking. Nothing wrong with that. And I will say that in the structure of an angel group, you have some of that baked in, because, in an ideal world, the deals come to the angel group vets them and does a cursory check to say, okay, legal entity check, no, liens, outstanding, things like that. Okay, IP has been filed. Okay, the documents look in check. So you don't have to reinvent the wheel. By the time that company pitches to the angel group, you know that some of those answers have already been provided.
I think, in the interest of the members who are on the call who have not invested thus far, I'd like to open the floor to any questions, and you're always free to enter a question into the sideboard that I can field over to Beto. So if there's any questions right now, we can go ahead and address them. And in the meantime, I'll go ahead and continue with some big picture questions regarding the current state of the economy, what it looks like to be an angel investor right now in this moment. But if there are any questions at this time, just go ahead and unmute and ask them. Otherwise, I'll just proceed. So thinking about the way we are approaching the end of the year right now, we're reflecting on the previous 3 quarters. What does the future hold? What does 2024 look like for angel investment? What are some of the sectors that are growing, and how is that all conditioned in the face of bigger events that are occurring? You have the government shutdown potentially on the horizon. this ever running fear of recession. How has that changed the atmosphere from say 2-3 years ago when it seemed like everything was free flowing, NFTs were hot, crypto was big? Has that done for the due diligence process for the angel investment community?
Well, I could tell you that there's been some things in the news at a national and international scale that have been unfavorable, right? FTX comes to mind, perhaps a few others. So I would say that angels are revisiting the due diligence, taking their time and making investments. Also, you should understand that if you're angel investing, it's probably something you want to do in some consistent basis because you want a certain number of investments in your portfolio to have some diversification. As mentioned earlier, some of these deals won't go well for a variety of reasons, right? There's high risk. And so you want to have some hedge against that by diversifying in the number of deals you do. That could include geographic diversification, stage diversification, etc. So that's one way to handle that, is something like that. Now, John asks, how does deal flow look for Southern New Mexico? Well, our sources of deal flow for Southern New Mexico are primarily driven by the relationship with New Mexico State University, right? They have a variety of different programs through Arrowhead, incubators, accelerators, and the like. A lot of those deals are very, very young, but some of them are starting to show some promise. So that's one aspect. The other aspect is some of the other initiatives that are being done in collaboration with NMSU, UTEP, SDTV, and other organizations, and doing like Dia de los Muertos and pitch contests and hackathons and things of that nature that unearth creativity in the region, and people start to work on that. I know that Arrowhead is working a couple of different cool sprints, among them a real estate one, there's always energy ones and blah. The other thing for Southern New Mexico is, you know, today or this week, there was an announcement of a particular manufacturer that supplies Tesla, right? That's opening up in Southern New Mexico. What that does, it begins to create the need, potentially, but realistically, for, you know, tier 2, tier 3 suppliers. So my guess, and this applies to Southern New Mexico and the region overall, is that there are a number of relatively small, sometimes underfunded, or sometimes funded only by a contract that they get from a large supplier, right? Small manufacturing operations that can scale at some point. So what I'm saying is, when this plant opens up, that's going to supply Tesla with some sort of battery technology, they're probably going to need other suppliers or small businesses operating in and around them. That should bode well for deal flow from Southern New Mexico. Some of that deal flow will be relevant and scalable in a large way. Some of it might be appropriate for an angel to say, you know what, this business needs 100,000. I know where the revenue is going to come from. This is comfortable for me. I want to make that investment. Does that answer your question? Awesome.
Hey, Beto, this is Josh. Good to
Hi,
see you
Josh.
guys. You know, in the beginning, you're kind of talking about, I was just wondering if you could, what are your thoughts? You know, for me, I'm in the med device industry, and part of what interests me in angel investing is the idea of diversification. You know, I mean, the stock market, you know, can only get you so far, and you don't really have, I like to have my hands on it a little bit, but what do you think about investing in industries that maybe, you know, you read about, it sounds cool, but you don't really know much about it? What do you think about all that? Sorry, my dogs are barking.
You know, I guess for you, if I understand your question correctly, you have unique expertise as someone who's been in the med device space for a while, right?
Yeah.
But you might have a proclivity to say, you know, there's not a lot of people that invest in this space, but I like this space. I understand this space and want to allocate some portion of my capital towards that. And then maybe something else comes up. You say, you know what? I don't know this AI stuff, but this AI stuff looks interesting. and it's in a different area, has nothing to do with med devices, what should I do there? The answer to me would be, you could approach it in many ways. One is, do I have an opportunity to place a bet on something that's small,
Yep.
and I can learn from them, right? So maybe that number is $5,000. You write a check for $5,000. You let it ride, so to speak, and you learn from them. There are platforms out there that allow you to do this kind of stuff. But, locally, there's probably few deals that you can do at that level. The other aspect you can do is say, well, who's investing in this company? So I want to now learn from the trust that this company, that this entrepreneur has gathered from other similar investors. Oh, okay, they have 10 investors. 2 of them are professors of AI, for that example. So they know something about AI. So we're not just blindly going after an area that, maybe I have zero understanding of. And maybe I can connect with those particular individuals. And that could be another way to make a more educated, approach into that investment.
Yeah.
Another thing you can say, look, I'm not quite ready to write you a check, but I want to learn. Can I get involved and learn? And as I gain comfort, maybe I write a check, maybe I bring others that write a check, but I want to learn what you're doing. And so you become an advisor or a sounding board, and you're involved in that, and you're learning a little bit of it, you're getting some exposure.
Yeah, that's great. Yeah. Yeah, because I mean, at some point, I'm in mid device, I've got a unique experience, and I'd like to keep investing in that. But at some point, you're not diversifying if you just do the same thing, And so I like the idea of broadening the horizons too. So that's good. I appreciate that.
You got it. Other questions, comments? Girish, Jorge, Miguel?
Beto, I have a question. When you are working with an angel group, how would you advise people on the differences between rounds of financing, between seed rounds and Series A rounds?
Yeah, so most of the deals that would probably come to an angel group are going to be pre-seed or seed, very early. If a deal is coming in its later stage, call it an A, right? That means they're raising a larger dollar amount and they're further along. You as an angel have to decide, what is my philosophy about investing? Do I want to own a percentage of the company that's interesting? In which case you write a bigger check earlier into a company? Or do I just want to diversify and use the same amount of dollars, call it 10,000, and I'm putting 10,000 in a company that's just getting off the ground and 10,000 in a company that's more mature. I know that my percentage ownership will be a rounding error, but I'm going to keep it, right? So the initial check, you have to really think about what makes sense for you, right? And most angel groups that are looking at seed, pre-seed deals, which are very early stage deals, they're looking at a certain band of valuation, right? I don't know, use a number, 3 to 5 million, 3 to 8 million. And so you're writing a check and you know what your percentage ownership is going to be. Now, how do you want to think about reserve capital is a very different question, right? Like, okay, if I put in 100,000 into this company and I own 10%, and this company does well, and at the next round of financing, do I want to keep my 10% or am I okay owning less of it? Do I want to invest some more, or do I want to let this 100,000 ride regardless of what the outcome might be? So you have to go through that exercise, and that exercise includes the math around the specifics of that deal, what's going on in the industry, and what's going on in your personal finance. Because as an angel, you're writing checks to yourself. You're not writing checks on behalf of someone else. Does that answer your question, Jeff?
Yes, thank you, Beto.
So we have about 5 minutes left. Any other questions for Beto?
So Beto, how do you get involved with Cruces Angels if you're on this call and you're thinking about joining? What do you recommend for everybody that's interested?
Yeah, so Cruces was created primarily as an educational platform for angel investing. So we welcome people who want to be members. go to suncrucesangels.org, the website. You can fill out the survey to become a member. You can pay your dues there. The dues are $500 a year, so very accessible. Year one, you pay $750. $250 goes to your swag and registration. And the other $500 go to the annual fee. Now, it's a nonprofit, so this is tax deductible. You get a statement when you fill out your membership and you pay online. That very receipt is what you can use for your taxes. So in sum, very easy to join the angel group, self-serve on the website. If you need to, you could also reach out to me or to Jack or to Joseph.
Thank you.
A question to riff off of that, who are we looking for in particular? I think it would be helpful, you know, what's the profile for an angel? And I think generally speaking, are we looking in Southern New Mexico and El Paso? But if you're, you know, it's, let's say in California, can you join the group and be involved in the region as well?
Great questions. We actually have a member from New York, an angel member from New York that joined because she's interested in what happens in our region. So you could be in different areas of the country and still join the group. Secondly, who are we looking for? You know, we're looking for people who want to be engaged and want to see the region develop. What does it mean? Well, you want to be engaged, meaning that you're responsive to outreach from other angels that want to get to know you, as well as share deals and learn from you. You care about the development of the region. You might have a little capital to invest, but you also want to see it do some good in our region. You want to see young entrepreneurs develop. You want to see ideas that come out of the university, see the light of day, and get commercialized. You know, if I had a magic wand and could say, well, what does the ideal angel look like? Well, I think she looks like 5 to 10 years of experience in an industry. It looks like someone who meets the SEC requirements of being an angel investor, which is annual income of $200K a year if you're single, or $300K a year if you're married, plus $1 million in net worth, not including your primary home. Okay, and you have some disposable income, whether that's 5% or 10% of your income that you want to invest. Ideally, it's people that have a variety of experiences across different industries: financial, legal, operational, marketing, and the like, right? Because a startup needs all that advice. So the ideal candidate is someone who's interested in the region, interested in our ecosystem, meets the requirements as per SEC, which are available on our website, and desires to contribute towards the development of our region.
And that mission is exactly why we at Stanford Angels and Entrepreneurs of Texas are really excited to be partnering with you all and with the group here in the region. It's so critical to be pressing as many buttons as we can to get our region to take off in a big way. And we're really pleased to be a part of this process. There are a few events coming up that we should tease as well. And one of which is Aggie Shark Tank coming up on October 5th. The Dia de los Muertos pitches will be held on November 3rd. So that event is something that we look forward to every year in the region. And you can check out more information on Dia de los Muertos and Aggie Shark Tank by checking out the chat. So thanks, Joseph, for posting those. And SCA will be organizing events throughout 2024. So this is going to become a much more routine thing to put on your calendar. And we'll have social events, pitch events, the whole 9 yards to make this group as active and informed as possible. So SCA wants everyone on the call to know, as a member, we've got your backs. And we've got each other's backs through the process. So we're all resources for you, and we want to provide a service that will help our region grow. And with that, I'll turn it back over to Beto if you have any other points to raise. Otherwise, we can send it over to Carlos to close.
I'll make one little pitch here, if you guys don't mind, for joining if you haven't. So I'm invested in a startup in town here, and Beto actually introduced us to another company just this week where we actually had some synergy, and they may actually buy something. We might get our first sale from them, so which would be very small, but a sale nonetheless. So you know, it's a little pitch for the Sun Cruces Angels, as I'm a member on the board, but it's actually not just about, the deal flow. It's about the entire, network. And, who knows where this will all lead, but, just people are always, it's connections, man. That's how the world works. So I just wanted to put that plug in. I hope you guys don't mind me doing that. So.
Not at all. Thanks so much, Josh. Cool. We can turn it back over to Carlos. You want to wrap it up? Thanks, y'all.
Thank you all. And I just want to say thank you for joining on Cruces Angels and for listening to this training session. And we look forward to sharing more resources and be in touch with the upcoming workshops and activities.
Thanks, everybody.
Wonderful. Thank you all. Take care.
Thank you all.
Good night.